Stock Market Rollercoaster: How to Invest Wisely in a Volatile Market. Let's face it, the stock market can be a real nail-biter. One minute it's soaring to new heights, and the next it's dropping faster than a rogue roller coaster cart. If you're feeling a little queasy watching your investments go up and down, don't worry, that's perfectly normal. But here's the good news. Even in a volatile market, there are ways to invest wisely and keep your portfolio on track. This video will give you the tools you need to navigate the ups and downs with confidence, even if you're a complete beginner. We'll break down strategies to keep you calm during market dips, help you spot promising investment opportunities, and build a solid plan for the long term. Let's start. Strategies for smart investing in a volatile market. All right, so we know the market's going to be a roller coaster, but how do we survive the ride and maybe even enjoy the view? Here are some key strategies to keep in mind. Stay calm and don't panic. Volatility can be scary, but remember, reacting impulsively is the worst thing you can do. Resist the urge to sell your stocks in a panic just because the market's dipping. Remember, short-term fluctuations don't necessarily reflect a company's long-term potential. Focus on the long term. The stock market is a marathon, not a sprint. Don't get caught up in the day-to-day noise. Invest with a long-term horizon in mind, ideally for several years or even decades. This way, you'll give your investments time to weather the storms and grow in value. Diversification is key. Don't put all your eggs in one basket. Diversify your portfolio across different asset classes, such as stocks, bonds, and real estate. This helps spread out your risk and protects you from being overly exposed to any one sector that might be struggling. Invest in what you know. Don't just throw your money at any trendy stock. Research companies you understand and believe in. Look at their fundamentals, their track record, and their prospects. Don't chase hot tips. Beware of get-rich-quick schemes or follow the hot stock of the day. These are often risky propositions and can lead to significant losses. Invest regularly, even when it hurts. This is a powerful strategy called dollar-cost averaging. By setting up automatic investments, you contribute a fixed amount of money at regular intervals, regardless of the stock price. This helps you buy more shares when prices are low and fewer shares when they're high, averaging out your cost over time. Rebalance your portfolio regularly. As your investments grow at different rates, your portfolio's asset allocation might shift over time. Regularly rebalancing your portfolio helps ensure it stays aligned with your risk tolerance and investment goals. This might involve selling some of your high-performing assets and reinvesting the proceeds in those that haven't performed as well. Know your risk tolerance. This is crucial. How comfortable are you with the possibility of losing money? Investors with a higher risk tolerance can invest in more volatile stocks that offer potentially higher returns. Those with a lower risk tolerance might prefer safer options like bonds or index funds. Don't be afraid to seek professional help. If you're feeling overwhelmed or unsure about where to start, consider consulting a financial advisor. A qualified advisor can help you create a personalized investment plan based on your individual goals and risk tolerance. Taking control, building your investment fortress. All right, congratulations. You've conquered the first hurdle, understanding the market's inevitable ups and downs. Now, it's time to translate that knowledge into action and construct your very own financial fortress, a strong and resilient investment portfolio that can weather any storm. Here's your blueprint, packed with actionable steps to get you started. Invest like clockwork. Automate your path to wealth. Building wealth isn't a get-rich-quick scheme. It's a marathon, not a sprint. Consistency is key. Think of it like building a brick wall. Each regular contribution is a sturdy brick that strengthens your financial foundation. Here's how to make consistency your superpower. Set up automatic investments. This is the magic trick. Schedule automatic deposits from your checking or savings account into your investment account at regular intervals, regardless of what the market is doing. Weekly, bi-weekly, or monthly, choose a frequency that fits your budget. Start small, but start now. Even a modest amount, like $25 or $50 per contribution, can add up significantly over time. The power of compound interest is on your side. As your income grows, you can gradually increase your contribution amount. Think of it as a future you savings plan. Every automatic contribution is a future investment in yourself. Treat it like a non-negotiable bill, ensuring you pay yourself first and consistently. Slay the debt dragon. Free up cash for investment. High-interest debt is a hungry dragon guarding your investment treasure. Before you invest a significant amount, focus on slaying this debt dragon. Those pesky interest payments can gobble up a significant portion of your potential returns. Here's your battle plan. Prioritize high-interest debt. Identify your debts and list them according to their interest rates. Focus on paying off the debts with the highest interest rates first, as they're the most detrimental to your financial progress. Consider debt consolidation. Explore options like consolidating high-interest debts into a lower-interest loan. This simplifies your repayment process and can potentially save you money on interest. Reframe your budget. Once you've freed up cash flow by tackling debt, redirect those funds toward your investment portfolio. Every dollar saved on interest is a dollar you can invest for future growth. Live like a king on a budget. Spend less, invest more. Living within your means might sound restrictive, but it's the secret sauce to building wealth. Think of it as creating a comfortable financial cushion and a launchpad for your future. Here's how to become a budgeting pro. Track your expenses. Awareness is the first step towards change. Use budgeting apps or spreadsheets to track your income and expenses for a month. This will reveal areas where you might be overspending. Identify spending leaks. Are there recurring subscriptions you can cancel? Daily coffee shop visits you can cut back on? Every small reduction adds up and frees up cash for investments. Embrace frugal fun. Living frugally doesn't mean sacrificing all enjoyment. Explore free or low-cost entertainment options like picnics in the park, game nights with friends, or visiting local museums on free admission days. Become a financial news junkie, but not the crazy kind. The financial world is constantly buzzing with news and updates. While you don't need a PhD in finance, staying informed is crucial. Here's how to become a financially savvy citizen. Follow reputable financial news sources. There's a wealth of information available online and in libraries. Stick to reputable sources like the Wall Street Journal, Bloomberg, or NPR's Marketplace. Listen to investment podcasts. Podcasts are a convenient way to learn while you commute, exercise, or do chores. Choose podcasts geared towards beginner investors and hosted by credible financial professionals. Take online investment courses. Many online platforms offer free or low-cost investment courses that can teach you the basics of asset allocation, diversification, and investment strategies. Asset allocation, building a balanced portfolio. Imagine your investment portfolio as a delicious pizza. You wouldn't want it to be all crust or all cheese, right? The same concept applies to investing. Asset allocation is the process of dividing your investments among different asset classes, such as stocks, bonds, and real estate. This helps spread out your risk and protects you from being overly exposed to any one sector that might be struggling. Stocks represent ownership in companies. They offer the potential for high long-term returns, but also carry higher risk. Bonds represent loans you make to governments or corporations. They generally offer lower risk and steadier returns compared to stocks. Cash equivalents include money market accounts and certificates of deposit, CDs. These are very low-risk investments that offer a small return but provide easy access to your cash if needed. A common asset allocation strategy for beginner investors is 60% stocks, provides the growth potential but carries more risk. 30% bonds, offer stability and income with moderate risk. 10% cash. Equivalents, provides liquidity and safety for short-term goals. Remember, this is just a starting point. Your ideal asset allocation will depend on your age, risk tolerance, and financial goals. Rebalance your portfolio regularly. Stay on track. Think of your portfolio as a well-maintained garden. Just like plants grow at different rates, your investments will have varying performances. Regularly, rebalancing your portfolio ensures it stays aligned with your target asset allocation. Review your portfolio, quarterly or annually. Track the performance of your investments and see how your asset allocation has shifted. Buy low, sell high, within reason. If your stock allocation has significantly grown above your target percentage, consider selling some of those holdings and reinvesting in asset classes that haven't performed as well. Discipline is key. Rebalancing might involve selling investments that are doing well. However, this helps maintain your risk tolerance and keeps your portfolio on track for your long-term goals. Remember, the stock market may be a roller coaster, but you don't have to be a passive rider. By following these strategies and maintaining a long-term perspective, you can take control of your investments and build a secure financial future. Don't let volatility scare you away. With the right approach, you can use it to your advantage and navigate the market with confidence. Thanks for tuning in, and we'll see you next time.